Thanks, everybody, for joining us here today for our last webcast of the year. And hopefully we won't start 2026 with a wildfire in Pacific Palisades again. We were evacuated for 3 weeks. So the year started out rough with here in California wildfires, but then we had the tariff tantrum in March and April. It seems like a distant memory because the markets fully recovered fairly quickly from that. Okay, so this is entitled "You Need It, We Print It," and that came to me because I saw a commercial for a visual display printing company, and that was something close to their slogan was "You Need It, We Print It." And it occurred to me that that's what we've been doing here increasingly with the balance sheet and the fiscal deficit being used to help the economy in fairly radical ways in the recent decades. These colored lines on the screen show the fiscal deficit, how much the deficit to GDP changed during the last 7 or 8 recessions. And what we saw is back in the 60s and 70s, it was fairly common for the deficit to go from almost no deficit to an increase of about 4 percentage points or 2 to 4 percentage points. And then came the global financial crisis, and we had a very radical response to that. And then came, of course, the COVID lockdown, where the deficit increased by almost 13 percentage points of GDP. So with the deficit now at 6 percentage points of GDP, although we're not in an official recession, we'll have to see what happens in the next recession. Will we break the record? Because the last 3 recessions sequentially were breaking the record of the deficit increase. So we also have another look of the deficit, what happened to the deficit during expansions. So in the old days, in the 50s, into the 60s and 70s, during expansions, the budget deficit didn't really increase very much. But here in the current expansion, which is officially started back in 2020, after a very short, steep economic contraction, we see that we've been running very high deficits as a percentage of GDP. As of the most recent data point on here, 66 months into this expansion, we're running at 6.2 percentage points of GDP. So if we combine the preceding slide with this slide, we can start to think about where the deficit might go when the economy starts to contract. Whenever that happens, we'll talk about where it might stand in that cycle a little bit later in this presentation. So let's look at what's going on with the debt. The average interest rate on Treasury debt got as high as 12% back early in my career in the 80s. And then we see that it was, on a secular basis, it was declining with some retracements, but it went from a 12% interest rate down to below 2% interest rate. And of course, that's because the Fed was at 0 and we had 1% 10-years for quite a few years in a row. And now we see that the deficit, the interest rate on the Treasury debt on average is up at 3.35%. So that's lower than where interest rates are today in the Treasury bond market. But at least this line has not continued to rise with the Fed cutting rates and having been a retracement from the high and longer term interest rates. We see that we're at least going sideways. As long as the Federal Reserve stays above 3% on the Fed funds rate, as long as treasuries are at 4% or higher, this line will probably begin to move higher again in the years coming. Here we see U.S. Treasury debt outstanding, which is $38.5 trillion now. I just looked it up on the debt clock right before this webcast started. So it's at 38.5 trillion, which of course is greater than GDP. And there have been studies done by academic economists that say that as long as your debt to GDP is below 90%, it's actually okay to have debt. But once you get above 90%, it starts to flip. And with the ratio that we're at right now, actually the academic studies say that every dollar of debt actually creates less than $1 of economic activity. So this is sort of a debt trap that we have entered into, and we'll see what's going to happen as we move toward the end of this decade. The average interest rate on Treasury debt outstanding, again, 3.35%. How much interest does the Treasury pay on its debt in a year? Well, it used to be about $400 billion. and now it's $1.2 trillion and definitely going up because we continue to add to the debt burden. And you can see on the bottom panel, the green line is Treasury debt expense as a percentage of GDP. So we've gone from a regime of around 2 to 3% to now 4% and continues to climb. One of the things that was really remarkable is M2 was going along at a fairly constant rate of growth. Look at the blue line in the top panel, and all of a sudden we got into the 2010s or post-GFC period, and we see that the M2 supply has started to increase a lot. And then we see the COVID response in the upper right. And of course, that created a huge bulge in M2. And then M2 declined a little bit, and some of the more monetary type economists pointed out that M2 went negative on a year-over-year basis, and some of these economists were calling for recession about 3 years ago. But the elevated level of M2 is what these economists were kind of missing in their analysis, because M2 is still very, very high versus the trend line that we experienced. And of course, what this did was create inflation. And here's the CPI, the core CPI, going back 20 years. And we see that it was moving along, core CPI was moving along at a 2% trend line for quite a few years in a row, about 15 years in a row. And then thanks to that M2 burst from the prior slide, we see that CPI went really elevated. It got up to 3 years ago, 3.5 years ago almost, got up to 9.1% on the headline CPI anyway. And we did this little study here to say, what would it take for future inflation? What would it have to be for us to get back to the 2% trend line over either 5 years, 10, 15, 20, or 25 years? And it's interesting that dotted horizontal line on the chart, that says that we would have to have zero inflation for the next 5 years for us to return to that trend line. It would be a 25-year trend line of 2% core inflation. If we're going to do that over 10 years, we would need to have a 1% inflation rate. 15 years, we would need a 1.3, and out to 25 years, it's about 1.5. It seems very unlikely that we will be able to have 1.5 inflation on average for the next 20 years, considering that we're running at 3% now and probably going a little bit higher during 2026. Seems like we're not likely to return to that trend line anytime really for most of our remaining careers, it would seem. Here's what the Fed looks like. Tomorrow's Fed Day. So last Fed Day of the year. And the Fed likes using the PCE inflation. So that's the only inflation index that I'm presenting today. And we see that the core PCE, the blue line, is running at about 2.8%. And so is the headline PCE. This is lower than the CPI and the core and the PPI, but it's not as bad as some of the headline inflation index for other indices. Here's the one that I always show: export and import prices. These are real inflation. There's no adjustments to this, and it's not running all that badly. We see export prices are up 3.8%, and weirdly, import prices, in spite of whatever tariffs have been put on, are only running year over year at 0.28%. So if we average import and export prices, we really do have, using these real inflation measures, about a 2% average inflation rate if exports and imports are equal, which of course they're not because of the trade deficit. But it gives a sense that inflation is not really that big of a concern. Perhaps that's why the Fed has been comfortable cutting interest rates a couple times. And I think the betting is about a 90% chance that they'll cut rates by 25 basis points tomorrow. Here's another real inflation number. This is the price of gold, which I've been recommending for most of this year. I talked about gold as a strong recommendation on our Roundtable Prime back in early January. And we see that the gold price just absolutely went vertical. We turned neutral on gold a couple of months ago, and that turned out to be an okay call because gold has sort of stalled out somewhere around 4,000 to 4,200. But we turned positive on gold again earlier this month, thinking that inflation broadly on commodities looks to be starting to assert itself a little bit, at least using the Bloomberg Commodity Index, which is on the screen right now, compared to its 200-day moving average. we say that we were living around that 200-day moving average, sometimes above, sometimes below for most of the last 2 years. But now the 200-day moving average has been breached. We're above the 200-day moving average by not a trivial amount. And the 200-day moving average is now rising. So we actually turned positive on commodities broadly last week and thought that it would be consistent to turn positive on gold as well, although it's really the broader commodity index that looks like it's showing signs of sort of catching up to that huge rise that gold experienced over the past couple of years. Here's one thing that is not inflating. This is West Texas Intermediate oil price, although it has kind of slowed down in its descent. It kept going to new lower lows over the past couple of years, but now we have not breached the low that was hit in the second quarter of this year. But oil seems to be extremely stable at around high 50s dollar prices. And if you look at the forward market on crude oil, it's incredibly stable going forward. For most of 2026, the curve of the oil market suggests that the market expects oil will stay around these levels throughout 2026. So not so much inflation from the oil market. So let's now talk about the economy and where we might stand. I'm not going to use a lot of high frequency economic data. I'm going to use ones that give very few false signals. And I don't have a lot of these slides, but the first one is on the screen now is the 2s-10s spread, the yield differential between 2-year treasuries and 10-year treasuries. And when you're in the red shaded areas, I'm not talking the vertical bars, those are recessions. I'm talking about the below zero shaded areas. That means that you're inverted. That means that the 2-year yield is higher than the 10-year yield. And that usually sets you up for being on some sort of a recession watch, particularly when it de-inverts. And that happened a while ago now, the de-inversion, where we went to above the zero line. But the signal I want to point out is when the 12-month moving average itself goes above the zero line. If you look back over the past, 5 recessions on the screen, or 6 recessions if you count COVID, you see that the 12-month moving average going above the zero line has given a very strong signal that you're not just on a recession watch, but maybe entering a recession. That hasn't seemed to work as well this time, but it's definitely showing a warning signal that's not just dimly flashing. Next one is the unemployment rate. And this one also doesn't give false signals very much. We've got the unemployment rate versus its 36-month moving average. And again, when you cross above the 36-month moving average, you're really starting to think about recession. But when you start to accelerate above the 36-month moving average, which appears to be happening here, not the convincing slope that we saw prior to the 1990 recession, the 2000 recession, the global financial crisis, but it does appear to be accelerating higher. And this is one of the reasons why I think people are calling for further Fed rate cuts, and probably why President Trump has been very vocal about wanting rates to be lowered. And I think there was an article just out today that Trump used the word litmus test for the next Fed chair pick. That will be a litmus test. Will they be more aggressive on cutting interest rates, which is in line with what I said at the last Fed meeting, which was the job interview for Fed chairman is basically one question: Will you cut rates aggressively if I've encouraged you to put it kind of nicely? So we'll be watching this one, and then we have the jobs plentiful, jobs hard to get ratio, which has been in a fairly good place, but now is reverting back towards more imbalance. And then we see the U3 unemployment rate tends to follow the movement of these shaded areas. And so this is further influence perhaps on the Fed's desire to continue to cut rates, which I think will happen tomorrow. Here's the 2s-10s curve. And now we've just overlaid the 2s-10s curve versus the U3 unemployment rate. And it looks a lot like the prior slide, of course. The blue line, which is the 2s-10s curve, it's very similar, but leads by a little bit, perhaps, the U3 unemployment rate. So these are now in sync also and moving in the same direction, which suggests, as I speculated about 3 months ago at the Fed meeting, that the Fed, when push comes to shove, and they have to decide between fighting inflation or fighting rising unemployment, they're going to pick combating rising unemployment, and it appears that that's the direction the rhetoric has taken. Now, this is really something. The University of Michigan Consumer Confidence Index has just been awful for the last couple of years. There was a moment of some strength, but it's at about the lowest reading of all time, going back to 1980, a 45-year all-time sort of pessimism from the University of Michigan. We'll see that the Conference Board consumer confidence in a couple of slides. It's nowhere near as drastic as this, and I have a sort of theory that I'll get to on why this is. So this is consumers saying in the University of Michigan survey, are they better off than they were a year ago? And this kind of echoes the prior slide, where people have come out of the absolute doldrums, but most people feel like they're worse off than they were a year ago. And I suspect that has a lot to do with the price level. While the inflation rate is nowhere near where it was 3 years ago, it's still going up, as we saw on the PCE. So people, they want prices to go down, and they kind of confuse inflation going down with they want not just inflation to go down, they want prices to go down. That certainly has not been happening. Okay, and now we get to the Conference Board Consumer Confidence Survey, and this is nowhere near as bad as that University of Michigan one. This kind of looks almost average, although when you get below that 100 line, it does put you on some sort of a notice of a weakening economy, as evidenced by those vertical red bars, but nowhere near as bad as the University of Michigan. But still, there are other things. If you subdivide, you parse some of these survey results. Here's one: expecting worse business conditions in 12 months. So people feel like they were better off 12 months ago, and they expect to be worse off in 6 months. So not a great picture for the consumer confidence using the more granular data. And then this is job expectations at 6 months, which also looks more on the pessimistic side from the Conference Board. Not at record highs, but certainly a decent percentage based on relative to history expects fewer jobs to be available in the next 6 months. And this is a really interesting. This is the University of Michigan now, and we're taking the actual survey results, which is that kind of brown line. And there's an exercise that somebody did that says, what would we expect the Michigan Consumer Sentiment Survey to be based upon, and it's down there in the bottom of the slide, so using economic indicators. If you just did sort of a regression of economic indicators relative to history, and you use the unemployment rate, inflation, consumer spending, and stock performance, you doing that exercise prior to COVID, the actual survey results and the predicted survey results using economic inputs were virtually identical. But now we have seen a monumental divergence between the actual and the predicted. Obviously, that has something to do with stock prices being better, but a lot of people don't own many, if any, stocks. So that's not really affecting a lot of the population. I think we have an on-average economy. When you report GDP is growing and things like that, it's on average. But I think you have the very top of the economy, say the top 5-10%, are feeling pretty good because they own stocks and they own assets and homes and real estate. But the people in the middle, certainly anywhere close to the middle, certainly those below the middle, they're feeling tons of pain because of all the electricity cost increases, insurance cost increases, rent increases, kind of you name it. And wage growth not really growing to the extent that it was a few years back. So this is a very strange dichotomy. It'd be interesting to see. I suppose what would get these lines to converge would probably be a drop in asset prices. Okay, so now we're going to get to some aspects of the bond market. Here we have the Fed funds and the 2-year Treasury. I always say the Fed follows the 2-year. I use this chart all the time because it proves that assertion that the 2-year Treasury, the blue line, always seems to lead the Fed. So back in the middle of the 00s, the two-year Treasury yield started to fall about a year, 18 months before the Fed finally joined it and started to cut. And then back in the middle of 2015 or so, we see the two-year Treasury yield started to go up, the blue line. And with about a 2-year lag, the Fed finally started to join it with a significant rate hiking cycle. And then the two-year Treasury rolled over and the Fed quickly had reverse course. So you can see that this keeps happening. So now the Fed has been behind the 2-year for a longer period than normal. And the two-year Treasury yield has fallen down to 357 as of this printing today. And so this is kind of why we would expect the Fed to cut interest rates. We use the upper band of the Fed funds rate here at 4%. I think the middle of the band is 3 7/8. So we're really only about 30 basis points below the middle of the Fed's range, and that would be suggestive of one more cut, in tomorrow, and then perhaps, depending on what the 2-year does, we'll see what 2026 might bring. So let's just take a snapshot of various spots on the Treasury yield curve. It's been a very much of a steepening yield curve going back to the Fed starting to cut interest rates back a year ago, September. We see the 2-year Treasury yield is actually at its lower end of its range going back for the past almost 3 years. And we see the 5-year Treasury in the upper right, a little bit above the low of the range from the last 3 years, but kind of below the middle of the range. The 10-year Treasury is kind of right in the middle of its 3-year range, and the 30-year Treasury is near the higher end of its 3-year range. Of course, this is what we've been expecting. We've been expecting that even though the Fed was cutting interest rates, that you would not see a significant decline, if any decline, in the 30-year Treasury bond, and that has certainly been the case. In fact, since the Fed first cut interest rates in September of 2024, the 30-year Treasury yield is up. This is something that has never happened before. But we're in a backwards world where, thanks to the fact that we have all of this debt, when the Fed starts cutting interest rates, people start worrying about the value of the dollar for the long term. They start worrying about how we're going to roll over all of the debt servicing as we move forward in time. So let's take a little closer look at some of this. This is the gross issuance of T-bills versus gross issuance of treasuries, total treasuries. And T-bills are 84% of the last 12 months treasury issuance, down from about 85.5 or 86% a year ago. Now, this is a little bit misleading because the T-bills can be issued more than once in the 12 months. So if you're borrowing 3-month T-bills, you issue them 4 times in a year. So it kind of gets 4 times counted, but still 84% of treasury issuance is T-bills, which leads to an interesting inflationary potential policy with the president wanting interest rates lower. He talks about it all the time. You would have a direct impact on interest expense if you slashed the Fed funds rate, because within a few months, you would have a lot of T-bills rolling off. 84% of all the treasuries issuance would be rolling off over a 12-month period. And if you cut interest rates by 200 basis points, you would have a significant reduction in interest expense. Now, let's take a look at what percentage of the total bond market, all fixed income, this includes all sectors of fixed income, including high-yield corporate bonds, for example, and 69% of all the bond issuance over the last 12 months has been T-bills inside of 1 year. And then we see down at the bottom, we have 37 trillion of total fixed income and 25 trillion of T-bill issuance. Again, there's some double counting when you roll over 90-day or 6-month T-bills in a 12-month period, but it's still an enormous percentage of the fixed income market issuance is in T-bills, which can, of course, be manipulated. This could be maybe an unspoken strategy. One way to get that interest expense down would be to get negative real interest rates on T-bills, which would probably cause some dysfunction at the long end of the bond market. If you're going to start running negative real yields, then people are going to start worrying about the value of the dollar. They're going to start worrying about how committed you really are to managing this debt in a responsible way. Here's what percentage of total issuance over the last 12 months is 20 and longer maturity Treasury bonds, and it's amazingly low at 1.7%. People talk about yield curve control, and if interest rates were to be stubborn on the long end or even rise in response to fears about the dollar or the way the debt's being managed, well, there's only 1.7% of the issuance over the last 12 months is long-term bonds. So you wouldn't have to buy all that many to control long-term interest rates. It's only about 2% of the 12-month issuance of the bonds. Looking more globally, this is 30-year bond yield movement in Japan, U.S., United Kingdom, and Germany, and they've all followed the same pattern, although the magnitude of the rise has varied. You've got UK and the United States have had big interest rate rises, off from rates down near 0 or 1% up to as high as about 5 to 6%. And then we've got Japan and Germany, which interestingly have exactly the same interest rate now. For years, it was Japan was always down way below other developed countries in terms of their interest rate levels, but now Germany and Japan are at the same place. So it appears that confidence in long-term debt management in developed countries is at a low point, and this no doubt plays a significant role in why gold has gone straight vertical, because gold is now viewed as real money. And it's interesting that this year gold has been up very substantially, silver even more, which is often the case when you get into more speculative aspects. But while silver is up a lot and gold is up not as much, but quite a lot this year, Bitcoin hasn't done much of anything. In fact, I haven't looked at it today, but last week, Bitcoin was actually negative on a year-to-date basis, at least part of the week. So it appears that people are losing interest in things that are as quite a bit based on speculation and on hopes, and are more interested in things that are real. And that would explain to me why we have strong returns in physical gold, and there's not much going on in the crypto market on a relative basis. Now, this is 1 month and year-to-date returns. I'm really just going to focus on the year-to-date returns. This is really interesting that while it's been a good bond year, these returns in the Treasury market, they're all 3.73 or higher. That's not bad, but you can see how good they really are in the belly of the curve, which we've been focusing on and recommending for investors. You see that the 2-year Treasury has a higher return than the 30-year Treasury year-to-date. And if you had, instead of owning the 30-year Treasury, let's just say it's 10 times the duration of the 2-year Treasury, if you had just leveraged up the 2-year by that amount, you would have much higher returns on a leveraged 2-year than you have on the 30-year bond. The number one performer is the 10-year, up 763. But again, you'd be much better off owning 2 5-years instead of 1 10-year. So again, we've had a steepening curve broadly for this year. Most of that was in the first few months of the year. It's been relatively stable now at about from between 3 years and 30-year, 2 years and 30-year Treasuries, about 120 basis points where it's settled into on a positively sloped yield curve. Here is an interesting chart. This is one of my favorites. I've been started using this earlier this year in webcasts. It's basically where what spreads have done in many sectors of the U.S. fixed income market. So we even have EM on here as well, off to the right-hand side. But the gold rhombuses, that's where the spreads were at the end of 2024, and then the blue bars are where we are today. And you can see that many of the investment grade things off to the left are pretty much where they were at year end. As you go lower in credit quality, you go down to, say, triple C high yield or triple C bank loan, you'll see that the spreads are wider than they were at the end of last year. So the market has been getting less and less comfortable the further down the capital stack you go. And we've been positioning this way, so benefiting from the fact that the higher quality sectors are what we're overweighted in and underweighted in lower quality sectors. That's been a good move for the year 2025 so far. You look off to the right-hand side, start to see that the spreads are a little bit tighter on the CLO market. We see the emerging market high yield is tighter. And so emerging markets have done well this year. Local currency emerging markets done particularly well this year because the dollar is down. We'll see that in a slide in a few moments. But I think that we start recommending local currency emerging market debt, but that's been a very good performing sector because the emerging markets have outperformed this year, and they've also benefited from currency translation. If you kept your dollar-based investment in that local currency, you have a profit on owning that local currency. Take a look at emerging market spreads. We now have two lines that we look at. There's the traditional line that excluded that includes Venezuela. That's the dark line. Venezuela was reintroduced into the market. It was excluded from the index for a while. So if you exclude Venezuela, emerging market spreads are at 219 basis points. That's pretty low. I think they've only been lower briefly in the history of the emerging markets back in prior to the global financial crisis. Including Venezuela, it adds on 41 basis points to the yield of the emerging market index. You're up at 260. But spreads have definitely been tightening for the past 3 years in emerging market debt. Here's investment grade corporate spreads. Those are also near tights, but investment grade corporate spreads have been quite stable. They widened a little bit earlier this year in the tariff tantrum, but we're kind of at about the lowest levels ever. We're at 71 basis points was reached September 19th, and now we're out at 77 basis points, so a very small widening. Investment grade corporates look to be lower risk than typical, thanks to the fact that a lot of borrowing has been pushed outside of the investment grade market, even outside of the public markets at all. And we'll be talking about that in the final section of my presentation. This is EM local debt returns versus U.S. corporate total returns, and then we compare it to the Dixie. So when emerging market debt is underperforming, it's usually because of the dollar is going stronger, and now the dollar is going weaker. It's inverted. The line for the dollar is inverted, the blue line. So the dollar is actually going lower, and now we see that emerging market local debt is outperforming U.S. corporate total returns, and that's something that just started really in earnest, I'd say, the first part of this year. I think this is going to continue because longer term, I remain dollar negative, thanks to all the debt that I'm constantly talking about that we need to have better management. Here's the U.S. dollar index long term. This goes back 50 years. And, the dollar definitely can go down. We see what happened in the 80s into 1990. We see what happened into the global financial crisis. And the dollar was strong there for about 15 years, but now seems to be stalled out and has not really changed much over the last 10 years, but more recently has been falling. I think that is going to continue. And once that, and when that does, I think we're going to see further outperformance for investors that are dollar-based in non-dollar assets, in emerging market fixed income, local currency, in various other stock markets, which have pretty much outperformed for dollar-based investors this year. Dollars had its worst year since 2000. Here in 2025, year's almost over, and we're pretty much down at one of the worst returns going back 25 years. So here is the S&P 500 versus emerging markets. This is just using the index levels here, and then we compare it to the U.S. dollar. It's pretty obvious that the blue line and the red line move together. So what that means is that when you're getting the trade, this is the trade weighted dollar strengthening, the S&P outperforms. And when the trade weighted dollar is weakening, you have emerging markets outperform. And that's begun, although it's not that powerful of an outperformance, it is not insignificant either. And I think that this is likely to be a good place to be investing, looking out, say, for the next few years. Now, this is something that's interesting. This is just on valuation. We can see that back 15 years ago, the Morgan Stanley U.S. index price-to-book ratio and the ACWI index price-to-book ratio and the ACWI excluding the U.S., they were all the same, kind of, at around 2. And since then, what we see is the equity, excluding the United States, has not really gotten richer over the past 15 years. It's gone sideways, whereas the U.S. index has gone to great heights and basically the highest valuation at any time in really kind of the past almost 30 years. So there's definitely room on a valuation perspective to see relative outperformance away from the U.S. stock market. As I did in Roundtable Prime back in January, I recommended for people buy non-U.S. investments. The U.S. did fine this year, but other jurisdictions have by and large outperformed. And here we are. This goes back now 55 years. This is basically the ratio of U.S. stocks versus global stocks, and we can see what the performance ratio is. We used to vary between about 0.4 to 1.3, and now we found a whole new realm where the U.S. outperformance has gone very, very high versus anyone's really experience, even going back to 1970. Here's my last slide on this. This is that I've used this twice before, but this is the U.S. net investment position. So when the red shaded area at the bottom is getting bigger, it means that more money is being poured in to the United States by foreign investors than is going the other way. And so going back 20 years or so, we've gone from about a 2% foreign investment position to a $2 trillion, I should say, dollar position of foreigners net in the U.S. to 26 trillion. And I noticed that it's not growing anymore. And I believe that this is going to be a trend reversal when we look at it a couple of years from now. And we'll say, well, one of the reasons that the U.S. outperformed very mightily on that prior slide was foreigners were pouring money in, the dollar was going up, and there was a win-win for foreign investors. Now it appears that it could turn into a lose-lose. And if that's the case, it could be self-reinforcing. I mean, with $25 trillion having come in over 20 years, what if, I don't know, 7 trillion goes out over the next 5 years or whatever period of time? Obviously, that would lead to underperformance on a flow of funds basis. So now I'm going to talk about private credit, which is an area that's getting a lot of attention because it's been growing very mightily. This slide shows U.S. state and local pension investment in private market assets. So this isn't just private credit, but it's private market assets. And it was steadily growing by, a couple $100 billion every few years. And then all of a sudden we started to really accelerate after the COVID experience. And now we have seen it looks like it's going to be almost a doubling. This goes through 2023, this data. So this is a lag data set, but I would conjecture that since COVID, this asset class has doubled in terms of pension exposure. Not only pensions, but life insurance, private credit. This is only private credit now, just private credit. This has increased significantly. It's up by about double over the past 6 years. So there's been a lot of money flowing into these categories. Also, university endowments. This is just the Ivies and MIT and Stanford. But what we see is private equity has always been, going back probably 25 years now, a preferred asset class for some of these big endowments. But now we're starting to see other private assets, including private credit. They're starting to be pretty substantial. And it looks like, Yale and Stanford and Brown have over 50%. So does MIT and Princeton to private markets. When we had problems on college campuses with demonstrations and the like, Harvard famously had to come to market to kind of pay their operating bills. So with their huge endowment, they didn't have enough money. I have a feeling that they're more locked up even than this exhibit really describes. If they need to borrow $2.5 billion to pay standard expenses, it seems like they're pretty locked up. And then we've got BDCs, business development companies, which are very much the rage. This is another sort of stampede, where we used to have publicly traded BDCs. Those have increased in recent years. Then unlisted private BDCs, those have been, looks like they've doubled over the past 5 years or so. And then we've got just a mania going on in perpetual life BDCs in terms of the AUM here. It's really gone from nothing 4 years ago up to a significant amount of a couple $100 billion at least here in the second quarter of 2025. So a lot of this has been money pouring in, which always leads to at least a temporary strong performance, but probably gets replaced with a lot of people wanting to get in on the action. It's kind of like the Wild West, and it's kind of small, getting started. You might have a good sheriff that's an honest person and everything's going fine, but if they discover gold nearby, the population comes pouring in and opportunists all show up, and not everybody's a good sheriff when you start to get that sort of population change. And I'm worried that this could be the case when we hit some economic hard times for parts of the private credit market. Here's the breakdown of the U.S. leveraged credit market. We have leveraged loans are 36%, 1.5 trillion. High yield is 1.4. That's both about 34%, but private credit is now 30% of the leveraged credit market. So it's really about a third. And one way to think about this is this private credit, 30%, probably in the past, mostly would have been high yield and leveraged loans. So it's my suspicion that the leveraged loan and high yield markets are stronger credit quality now than they were prior to this boom in private credit. And I think that private credit, by its very nature, is unregulated. And that means that there can be some bad actors in there. And we've seen some things going on in the headlines recently about private credit firms swap debt for equity. So there, we see, all these various headlines. My name's on there too. I pointed out in a TV appearance that I think high yield is better credit quality than in the past because the marginal companies are probably going to private credit. They can get a credit rating from the non-standard credit rating services, not Moody's and S&P or Fitch, but other smaller credit rating companies. And some of these deals, they get an investment grade rating, but it reminds me perhaps of prior to the global financial crisis when there were some small rating agencies that were basically willing to give you a rating depending upon how large a fee you were willing to pay them. And I'm not saying that happens all the time, but I do think that there's probably something going on when you start having non-standard rating agencies giving investment grade ratings. I think somebody had a quote on the newswire that if you only have one rating agency willing to give you investment grade ratings, it probably means that most of the others wouldn't give you an investment grade rating. So the risk is worse than you think. There's been a lot of bond issuance by big tech companies. Just take a look at the move from 2024 of $20 billion to through the first 10 months of 2025, where it's $93 billion. That's going to be a theme, no doubt, for 2026. We're going to see a lot of bond issuance in some of these new data center and AI parts of the economy. But one thing that's interesting is not everything's behaving typically underneath the surface. This is Oracle and market broad CDX, and they tracked each other pretty well. But suddenly Oracle has gotten very, very disconnected from the CDX market broadly. This is being touted as happening because people want to hedge their bets against some of the high-flying stuff that's been driving the stock market, Magnificent Seven, the AI, and all that stuff. And one way to do it is to take your exposure on a company. And so if you are demanding more for CDX, it means people are trying to hedge perhaps some of the book that they have exposed to these high flyers by getting involved in Oracle. That reminds me of AIG back prior to the global financial crisis, when Wall Street was hedging some of the securities that ended up being bad securities by shorting AIG, for example, and causing actually a stress on the company. So this is stuff, interesting developments that suggest we're not in the early innings of the activity in these high-flying situations. And that's also true of CoreWeave, where it's disconnected from the CCC index, with the premium over treasuries just expanding. On CCCs, it expanded by about 75 basis points, but on this one example, the spread has gone up by 250 basis points. There's some sort of cracks developing if you take the time to look granularly beneath the surface. Here's another thing to talk about. This is marks on a certain loan package that was owned by at least these 7 private credit type of firms. And back June 30th, this was from the source of this is Bloomberg, a story that they had up, that June 30th, they basically were all marked at 98 or 100. And then Blackstone started to mark them down in September of 2024. And then at year end 2024, started to see everybody starting to mark them down. And then just last September 30th, suddenly there's this huge spread where one firm has it at 91, another firm at 77. And there was an article also on Bloomberg talked about there was a credit position that was marked at 100 by a certain firm, reputable firm, and then a few weeks later it was marked at 0. So this is getting a little bit interesting when you have an unregulated market where the marks are quite inconsistent from firm A to firm B. It probably means that some people are gradually kind of moving average, changing their prices rather than doing it at a more timely basis. And here's another trend that's not terribly reassuring, and this is private equity issuers dividend loan volume. So private equity firms are tapping debt markets to pay dividends. So they're kind of doing a pay-in-kind type of a dividend distribution. And this is privately rated credit held by U.S. insurers. This is you can see the specialized rating agencies becoming more important there. Now, here's my last 3 slides. This is pretty interesting. This is data centers is this incredible growth, private fixed investments and structures by selected types, which just had this explosion in data center private investment. And this is really interesting. The vertical line, dotted line here is the ChatGPT 3.5 release, November 30th of 2022. And at that point in time, the nationwide average electricity prices were virtually the same as those of the top 5 states with the most data centers. But all of a sudden, thanks to ChatGPT and everything that's going on, whenever we're trying to get going with AI and requiring all this electricity, we see that the national average hasn't changed much at all since November of 2022, but the top 5 states with most data centers have had a quite significant electricity price increase, and that appears to be accelerating. So this is another thing that is dividing the country, I would say, where you've got certain states that are getting very high electricity costs. And my last slide shows that this is residential electricity prices. So the national average has definitely gone up, but the top 5 states has increased. So the states that are having the most data centers are going to start getting a pushback, I think. Not in my neighborhood. I know there's some demonstrations in some places where data centers are starting to become courted or encouraged, and the people that live there don't want them in their area because they know that it's going to be correlated with rising electricity costs. So it's kind of an interesting situation. And with that, I can turn it over to Andrew.
Thanks a lot, Jeffrey. So I'm going to change my normal cadence and cover positioning the fund first, and then highlight a few areas that we're seeing some interesting opportunities. As Jeffrey mentioned, if you do have some questions, please get those in, and we'll address as many as possible before the conclusion of our last webcast here in 2025. On this slide, what we're looking at here is the total return bond fund. It comes in several fund offerings, depending on how you'd like to access this fund. You can note down the ticker. It's in the second row of the table here, and essentially just look that one up. A lot of numbers, and I won't go through all of them here, but I'll just point out that as of November 30th, the total return bond fund, and I'm quoting the iShares here, DBLTX, it is outperforming its benchmark by 60 basis points year to date. We are happy about this and still focused here given there's a few more weeks left in the end of the year to really build upon that lead. For the fund, I'm going to start by talking about positioning and composition of the fund. The portfolio is composed of agency, which are government guaranteed investments, and also non-agency securities, which are non-government guaranteed. As of the webcast, over 50% of the portfolio are government guaranteed assets, and these would include the Treasury and agency portion of the pie chart. So you can see that here. Agency MBS are our largest portion of the fund, and this is going to include the pass-throughs, which are the lighter color blue, and then the darker blue, the CMO portion of the overall portfolio as well. The balance of the portfolio is in securitized credit. These are diversified across residential and commercial real estate exposures, CLOs, or collateralized loan obligations, and also asset-backed securities. The fund's duration is positioned slightly shorter than the index, right around 5.5 years. So it's about 0.6 of a year short versus the index as of 11/30. Focusing just on the blue line on this page, which is a time series of the fund's duration, you can see that we come off our highs or longs, if you will, but still elevated duration, especially when you compare it to where we have been historically. And then in terms of key curve positionings, here we're looking at key rate durations. Curve positioning has been accretive for the fund's performance during the course of the year. The blue bars here represent key rate durations for the fund, and then the gray represents key rate positioning for the index. You can see there's some differences. We are overweight the 2 and 5 year part of the curve and underweight the long end, the 30-year part of the curve versus the index. A few portfolio statistics, again, comparing versus the index here, which is the US Ag. You'll notice that we do have a lower dollar price. And this does give our investors better convexity versus investing in just the index. I also highlight that we are able to do this with shorter duration, so less interest rate volatility, and then also 70 basis points of excess yield. So we do have a yield advantage versus the index as well, despite some of the other advantages I just pointed out. Talking about a few of the sectors that we are seeing interest, mortgage investments, they have been outstanding this year. And there have been a couple of reasons why that is the case. This slide kind of depicts the first reason. Mortgage rates have been hovering between 6 to 7% for the bulk of the year. So the yield or carry of newly issued mortgage-backed securities has been really attractive for investors. Looking at this chart, it does depict the carry of the MBS index over time, and it is higher than at any point in the last decade. So investors in the space, they are receiving very attractive income from these securities, which certainly has helped performance during the course of the year. The second reason why mortgages have done quite well this year is really due to price appreciation of certain mortgage-backed securities. A lot of mortgage-backed securities were created back in 2020 and 2021 when interest rates were very, very low. These assets are now trading at low dollar prices. You'll have to remember, agency mortgage-backed securities are government guaranteed, which means ultimately they pay off at par or 100 cents on the dollar. As the pace of refinancing picks up or housing activity increases or even defaults pick up, these securities will move back to par at a faster pace. And this certainly improves the investor's outcome with these securities because they are purchased at a discount. In bond lingo, we like to say they exhibit attractive convexity, which means there's essentially more upside than downside associated with these investments. Looking at this chart, we can see at the current price point, mortgage-backed securities are more attractive now than at almost any point over the last decade. We don't take a passive or index approach to investing here at DoubleLine, and that's going to include all the subsegments of the total return bond funds and strategy. On the slide, we're looking at the makeup of the agency mortgages in the portfolio. The left segments, CMOs in gray, I guess, CMBS in tan, and then the other segments in dark blue are non-index securities, meaning investors who invest in just the mortgage index or in the ag will not have access to these areas. And then on the right, pass-throughs are included in the index. They account for about half of our agency mortgage exposure, but even our approach to pass-throughs are nuanced, and I would say very not index-like. Let me kind of walk through that next. So if we zoom in on the pass-through exposure of the fund, here we're comparing our allocation, and this is in blue, versus how the index is allocated in gray. There are three segments here. They're broken out by coupon ranges. So for the higher coupon mortgages, and I'm talking about the far right segment, this is 5.5% to 7.5% coupon stacks. We do have an overweight versus the index. So the blue line is considerably higher than the gray line. And this is really where we access the carry advantage associated with some of the mortgages at the higher coupon level. At the other end, so the far left here, we're just a hair overweight the lower coupon mortgages. These are positively convex portion of the market, and it does certainly add value as well. We are underweight the middle portion. We see the least value here, so we are underweight versus that of the index. Pass-throughs, they are an index product, but we do take an active approach to investing even here, and it certainly has helped create some outperformance for the fund this year. Another area that we've been quite active in has been in the commercial mortgage market, and there's still quite a bit of noise in this space, but I can say fundamentals are improving. Here we see valuations rising across almost all segments of the commercial real estate market. And if you look at the yellow, which is office, even the office space has really kind of found some footing. And this has really helped securities rebound off their lows during 2022. So CMBS assets or commercial real estate assets have done quite well for us during the course of the year. Spreads in CMBS, they continue to remain wide. And we continue to see opportunity for investors in this space. The blue portion of these area charts, it does show CMBS offers more spread than similarly rated corporates. There is a difference, and that difference becomes more pronounced as you move down in credit rating. So there's additional spread to be had as you move down in credit rating. Of course, there's additional risk. So we are being very choosy here. We are picking our spots carefully and making sure that we approve of both the collateral types and the structure as we continue to add commercial real estate into the total return bond fund. A quick visual here of how our exposure to CMBS and the total return bond fund has changed during the course of 2025. The red bars show the allocation at the end of 2024, and then the blue bar or bars are really kind of showing the most recent month end, which is November 30th. We've increased conduit and commercial real estate CLO exposure for credit and relative value reasons, and then alternatively reducing SASB or single asset, single borrower transactions during that course of time. 2026, the outlook seems like there will be a really robust issuance for commercial real estate going into next year. And given we're seeing improvements in collateral quality, it may make sense to increase SASB exposure. And certainly we will keep you abreast as we make these changes, but have been quite active in commercial real estate this year, and it has been accretive for the fund's performance. Shifting gears, Jeffrey spoke about consumers. There have been a lot of concerns about the consumer this year, and we are seeing some interesting data. Here, what we're looking at are loss rates by year within the fintech lending space. And this is data from actual transaction data. The blue line shows 2020 as a very low default vintage, meaning very low losses on anything issued during the 2022 year. And that makes a lot of sense given how much stimulus was essentially flowing through the economy. Now, the green line represents the 2024 vintage. And, what's notable here is because the loss trend for 2024 more closely resembles 2020, or at least follows the trend of 2020 experience and not the debacle of 2022 in orange, there are some changes in lending standards that we're noticing. We are seeing lenders being much more disciplined in their lending practice this time around, and this is going to be positive for the lending space. We are seeing fewer defaults and also fewer defaults within the consumer lending space in fintech. And also note that this discipline isn't just confined to fintech. We are seeing it in auto lending and other forms of personal loans as well. So I do see this as a risk mitigant going ahead into 2026 here. Here, we're looking at the composition of the ABS or asset-backed security segment of the total return strategy. We noticed the deterioration in consumers when it began in late 2021 when stimulus was lifted, and we actively began reducing our exposure. And you could see this with the shrinking of the lighter blue segment of this chart. In place of consumers, we increased hard asset exposure, and that's going to be the tan portion. These are more infrastructure-like investments and have contracted cash flows and can remain quite resilient even when the economy slows down. And then the last topic that Jeffrey spoke about, data centers, the dark blue represents data telecom. So this could be data, this could be fiber optics. This has been kind of a mainstay in the portfolio. We've been investing in data centers since 2017. Clearly, there's a fervor around AI, but I would say that our data infrastructure investments are largely focused on non-AI applications. So here I'm referring more so to like cloud storage and everyday applications that we all use. Perhaps tangentially related to AI, but we do expect that as massive capex continues in this space, there will be more opportunities. And again, we will be very choosy as we access this area. Just two more slides for me before I hand this back to Jeffrey. This slide here covers really the credit portion of the fund and shows how resilient our positions are. The blue bars depict the credit enhancement or our security's ability to absorb defaults before seeing even a dollar principal loss. The red shows serious delinquencies. So this is not even defaults. These are just serious delinquencies. We have favored higher credit quality for a couple years now. And from this chart, you can see that we can take quite a bit of stress for our positions and stay principally intact, meaning not lose a dollar principal across all of these sectors. So we do sleep well at night with portfolio positioning this way. And then the final slide. The fund has had a strong year. And once again, we've outperformed our benchmark, which is the US Ag. We also put in on the far right a much riskier index, the high yield corporate bond index. The strongest performing subsector for us has been mortgages and treasuries. You could see that on an unweighted basis, producing a 9.1% return. So much higher than what we've seen with US high yield this year. And again, remember, treasuries, agencies, these are government guaranteed assets. So we've done so with a very well protected portfolio. The credit portion has also done very well and contributed to the fund's performance. Our goal is always to generate the best risk-adjusted return for our investors. And based on these figures, we are proud of what we've been able to accomplish this year and really aiming to do something similar in 2026. So with that, I do want to wish everyone out there happy holidays.